tonight. Yes, I am running late. I had somebody just remind me that I was running late. I just wanted to make sure that everyone was on and ready to go. I know that it is the last day of work for a lot of people, and we're into the long weekend, Easter break as of tomorrow, or everyone's probably clocked off by now. So I've got a lot to cover tonight. This session is going to go for probably 90 minutes. I'll try and power through it as fast as I can. I was even adding more stuff to the presentation because I wanted to share as much as possible. I was doing that literally 10 minutes before now. So I was even adding more things that I thought of as I was thinking about what I wanted to tell you guys tonight. I actually have cut out a lot of stuff as well that I didn't think was important. So I've just tried to pack as much information in this session as I can. So I'm going to get stuck into it. Hopefully I can see everyone over all the different platforms in the chat. So if you have any questions, please don't hesitate to ask, and we will kick off. All right, Liberty Blue Education was founded by myself. It's designed to help you to make money from property so you can retire early. That's the aim of the game. So what I'm going to teach you tonight, and as I mentioned before, is to ask questions as I'm going. I will try and answer them as I'm going as well if they're relevant. Otherwise, if you've got any questions, I will answer those ones at the end as well. So I'm going to show you how to use at least 50% of your tax dollars to own property. So take advantage of what's called depreciation. I'm going to show you what the actual comparison is. A lot of people have a conception or misconception about depreciation. So I'm going to debunk that myth. I'm going to talk about what's going on with interest rates and where we're headed with the interest rate cycle, the key economic factors affecting property prices. I'm going to tell you a number of areas that are going to boom, and I had to leave out the bus section. So I'll save that for next time, but I'll tell you those ones that are going to boom. I'll save the bus section for another video. I've unfortunately packed enough info into this that we're going to run out of time. I had a lot of requests from people about renovations. So I've put in one of my renovations from a few years ago where I made $53,000 basically in a week and a half from one renovation, and I did it in my lunchtimes. And then at the end, asked me anything. So I want everyone to walk away with as much information as they can. I will make this available to my network after the session as well. So if you do miss something in the session, I'm going to make it available, or if you want to go over it, I'm going to value pack everything in here. So just to give you an idea for people that don't know me, I've got a couple $100 million of projects on the go. I started off doing my first development when I was 22, and this was it here. It was in a suburb called Morningside, 5 Ks east of Brisbane CBD. This is it on completion. That photo was only taken about a year or so ago. So I'm really proud of that project. I did that 14 years ago. I started that. So I've been doing property development for a little while, and I did start off young. And this is the property here. So what I did was took 2 existing houses, and I used those houses, renovated them, and I split 3 in the backyard. So the houses on the front kept on the left-hand side, and then in the backyard, I built the 3 townhouses. So that was a $3 million deal back then. It's probably $5 or $6 million now, some 14 years later. So putting the deal together, this was a creative deal I did, and I have a couple of programs. The first one is a buy and hold, where it's just a passive investment, and then all the way up to accumulating multiple properties and building a big property portfolio, and then through to development like this one. So I put the deal together using creative finance. I had no money when I started, or very little money at 22 years old when I just finished university. And so I needed some help with, one, the deposit, but then secondly, having somebody help to fund the actual construction of a $3 million project. So I did that basically with no money, and I made good money for myself back then, and then for my other parties as well, the landowner and the other investor. If you want to know more about that, I've got more details about how I put that deal together in other videos, and in my training program, I go through a lot more in-depth detail about those strategies, but I'm not going to cover that tonight. Just a little bit about my background. I studied civil engineering, got a bachelor of civil engineering. But what I found when I finished university, or even when I worked during university, was I was working 5-6 days a week, every week, 50 to 60 hours per week when I started, and that ramped up to like 80 hours per week by the time I was 27 when I quit work. And as much as I enjoyed engineering, I didn't enjoy being at the job, and I also didn't particularly like what I saw myself doing for the next 10 years or 40 years, and then only to retire on the pension. So I started to go to basically every seminar that I could find when I just finished university. I met a few mentors, and I did every single seminar. I spent an absolute fortune on education. It obviously paid off because I bought that property that I just showed you. I actually bought that less than 6 months after I graduated university. So hence I said I had basically no money because I'd been 6 months in the workforce at that point after graduating. So I had a vision even back then when I was 22 that I didn't want to work away. I didn't want to be working 80 hours per week and basically working for the rest of my life. And my motivation, and I think you really got to have that burning desire, that motivation to be able to do something different. Otherwise, what's the point? Without that motivation, you're not going to do the extra hours that it takes to get ahead with investments or even just step out and take that risk that is maybe perceived risk at the start, but you de-risk it by gaining knowledge and gaining confidence. So for me, my biggest motivation was actually my family. This is the little kidlets there. So I ended up with 3 girls. I'm very lucky. They'll all look after me when I get older. Maybe try for the boy next. We'll see. I haven't quite convinced my partner of that yet. So they're my 3 awesome girls. And that was my motivation back then. I wanted to have a family and I wanted to be around for my family. Just some stats that I hope scare you a little bit and make you want to do something a bit different from the 9 to 5 is 62% of Aussies retire on the pension, 82% are on the pension by 80. So those that really retire not on the pension but are self-funded, the people that are wealthy is actually less than 1%. So 1 in 100 people actually retire to be what's considered wealthy. Now you've still got around about 4% that retire comfortably, but it depends on what you actually want to do in retirement and when you want to retire by. So the question I suppose you need to ask yourself is how much do you need in retirement? Because you need to start thinking about it now. And the closer you are to retirement age, the more you need or should be thinking about it. But even if you're in your 20s, think about when do you actually want to retire by? Do you want to retire in your 30s or at least have the option to so you can do things that you enjoy doing? So how much do you need in retirement? Because if we aren't going to do something different, we're going to end up on the pension. And unfortunately, in the next 20, 30, 40 years, whenever that point is, it's coming up soon, there is going to be no pension. So I find this photo really scary. And it is a reality for a lot of people to like, this is your retirement. It's basically a nursing home or, a home where you're not doing much because you don't have the income to do it. If you retire on the pension, you're not doing much at all. You're just sitting around watching TV, which is going to be pretty bored. So think about what you actually want to do in retirement, because that's going to be your driver or part of your driver. Do you want to sit on a beach somewhere? Do you want to go on a cruise ship? Do you want to do fun stuff like this? Because you can't really do that when you're 65, 70, or if you do, you'd be one of only a few that are doing that. So do you want to do that? Do you want to volunteer for organizations? So I think it's really cool that people have the time to volunteer for organizations. But to get the time back, you generally need to have that passive income. Unless you're living on baked beans and toast or somebody self-funding you, or you're raising money to, do the fundraising or to volunteer your time, you're going to need to have some passive income where you're not working it, it's paying you. So how much do you need in retirement? And these are some stats which it might scare you a little bit, but this is reality. If you're having passive income, and the normal passive income amount for a couple is around about $2,000 per week now to be somewhat comfortable, you need an asset value of $2 million. That's outside your own home, by the way. So if you want to live on $3,000 per week, that's $3 million asset value, and obviously $4 million asset value. So that's like general rule of thumb. That's around about 5% return. So assuming you've got an investment property that's giving you a 5% return on the value of that property, you need basically $2 million of property value unencumbered, so no debt on it, to be making $2,000 per week, which is $100,000 per year. And I think that's probably the baseline comfort level, and that's in today's dollars. That does not include inflation over the next 20 years. You add inflation to that, we're all needing to be living on $4,000 per week as a couple. And that's if you want to actually do stuff rather than watching TV and eating baked beans on toast. So here's some fundamental concepts about putting money to work rather than being at work. So you've got two different types of earning money. You're either at work or you're putting the money to work, which is that passive income. So over your lifetime, you will earn a fortune, whether it's in your job, in a business, wherever that is. So generally 10% goes to everyday expenses, things that you buy day to day. 30% generally across the board goes towards tax, and 60% goes to home mortgage, rent, family expenses, and major commitments. So that's generally how it works. So if you are looking at where you're spending your money, you might be slightly different to this. Some might be up, some might be down. This is just generally the stats. So I want to just challenge your thinking a bit. Let's flip the switch on where your tax dollars are going, because you can utilize your tax dollars in property and using property investment. And I'm going to give you an exact example of this. So why not halve the amount of tax you're paying and instead put that into that 60% column, which means that you've got that extra 15% in your income to then go and use it to pay down properties or use it to hold properties and build that portfolio. So the government actually incentivizes us, you and I, to own properties, and this is how they do that. So they do it by giving us tax breaks. Now, I know there's been a lot of talk about them changing or removing the depreciation or the tax breaks for property investors. If they do that, they're going to create a massive rent bubble, rent crisis, because the property market in Australia is held up by private individuals. Most people only own one or two investment properties, so they're not going to change that in a hurry. It's going to pump rents up substantially. So this is going to be around for a lot longer, and everyone's taking advantage of it. That's a property investor, and the more properties you own, the bigger the advantage. So much like a car depreciates, so just from simple principles, you want to use the same principles of a car losing value as a house losing value. Now, a house is obviously an asset. A car is definitely not an asset unless it appreciates in value and it's a collectible. But think about a new car. You buy it for this one, $36,000. After 4 years, it basically halves in value. That's number 2 there on the screen. And then number 3 is basically when it's lost the majority of its value after 10, 12 years. And then there's not a whole lot of depreciation left. In other words, it doesn't lose a whole lot of value after around about 10 years. And that's pretty typical. Properties are slightly different, but consider the same principles as a car losing value. Now, a property, the actual house, technically loses value on paper, and that's how you can claim the tax breaks back. So new properties have a massive advantage over old properties. I'm not necessarily 100% for new properties, but even if you buy, or consider if you buy a new property versus an old one, and I'm not going to do that comparison here, but I have done it before. A new property gives you a whole lot more money back in your pocket. I'm going to show you in this example, versus buying a second-hand property, which isn't going to give you as much back. Yeah, sure, it might have a little bit more capital growth, but the key is to buy as many properties as you can. And if that one second-hand property limits your ability to then buy another property, then you're actually better off buying 2 brand new properties using the depreciation. But I'm going to show you what this actually looks like. So this is a real example. I've picked this from a Brisbane suburb. It's actually a suburb I'm developing in at the moment. So this property, it looks like a run-of-the-mill house, but you can see that it's got 2 letterboxes. It's returning $6,500 cash in your pocket, or in this person's pocket, every year. And it was a $730,000 purchase. Now, these are not $730,000 anymore, but that's what it was. And it's growing at $70,000 per year. So this property is about a year old, and it's grown about that amount, about $70,000 per year growth. So not only do you get the cash flow, you get the growth as well. And a lot of this has got to do with the brand new property. So purchase $730,000, rent $820,000. So let's have a look at some of the costs. So you got mortgage, interest only. With investment properties, you put them on interest only. You don't pay off the principal. Yes, the rate is going to be higher, but there is a strategy behind this. You got rates and taxes, maintenance $600, insurance $1,800, management $3,300. Total cost is around $40,820 for this property. Then you got to have a look at the income. So this is the rental income. Remember, this has 2 mailboxes for those people that have just jumped in. 2 mailboxes, dual income. So now your net cost, which is your income less your expenses. So this is about $2,000 a year. So it's basically neutral. Doesn't really put that much back in your pocket, but it's the depreciation advantages. So depreciation on this is about $16,000, which means you technically have $14,000 of write-off. So that is paper write-offs, so paper losses. This is not real losses because you're actually positive by nearly $2,000 a year. So you got write-offs of $14,180. So this is going to vary depending on your situation and all that stuff, that little disclaimer down the bottom. So let's just take an income of $120,000 on this just for argument's sake with the tax. Obviously, if your income is higher, this is going to be even better, but I'm just going to use a really conservative scenario. So your tax is normally $29,467. You got write-offs of $14,180. So now your new taxable income, and you can apply the same strategy to whatever your income is. And if you've got these write-offs, so now your new taxable income is $105,000. So now your new tax is only $24,859. So you actually get a refund of $4,609, which means that this property now gives you a cash flow of about $6,500 per year or $536 per month. Now, one other thing that so many people don't know, I heard this a number of years ago, it was actually from a seminar that I went to. You can actually get that refund. So if you're an employee, you can get that refund in your payslip. So instead of the employer holding the tax back, they actually give you that back every week if you get paid weekly or fortnightly or monthly. So there's a form you need to lodge to be able to do that. You need to talk to your accountant. If your accountant has never heard of this stuff, you need to sack them and get somebody that does. I have a fantastic accountant in Brisbane. It's taken me 6 accountants to find them. If you want their details, they are AH Jackson & Co. I recommend everyone to them. They are exceptional. I get no kickbacks for this, by the way. I just refer them because they will help look after you, and hopefully you can build a big property portfolio, and maybe you might even do one of the courses that I offer or buy a property from us or whatever. So this gives you $536 per week, per month in cash flow in this example. So obviously if your income's higher, you're going to get a bigger refund on this, which means it puts more money in your back pocket. So the massive advantage with a new property is you're going to get a refund of $4,500. If this was a second-hand property, for example, and you bought it and it had a lot of land that it sat on and you thought, oh, okay, the land's going to appreciate so much more than if I buy a new property. Yeah, that might be true to an extent, possibly, but your rental income is going to be less. Your write-offs, your depreciation is going to be less, which means you're going to get a lot less refund, if any at all. So in other words, this one, even though, yeah, you might have to give up a little bit more capital growth, it means instead of buying one of these properties, you can now buy 2 and 3 and 4 and keep going versus one secondhand property. Your serviceability is stuffed and then you're stuck with one. So just consider that if you're thinking, okay, I don't want to buy a new property, or I'm looking at these secondhand ones that are 20, 30 years old and I think they're really good value. That might be the case, but it's going to stuff up your serviceability moving forward, and it's going to limit you from borrowing and building a big property portfolio. So let's talk about property prices and what's really happening with property prices and also with interest rates, because they're somewhat linked, not directly linked, but they are somewhat linked, especially now with how everything is gone. So the statement from the Reserve Bank says, and this is just released not long ago, so cash rate was unchanged, whenever that was, last week. And the other bit I highlighted, so the monthly CPI indicator was steady at 3.4% over the year to January. I'm just going to power through the highlighted bits. The first sentence, the central forecasts are for inflation return to target range of 2 to 3% in 2025 and to the midpoint in 2026. So this is what the RBA thinks. We'll return to this target inflation rate that everyone's been talking about for the last 3 years. It's going to return hopefully to some normality next year in 2025. I think it's going to be a bit earlier, but they think it's going to be in 25. And then the next bit, returning inflation, the next highlighted bit, returning inflation to target within a reasonable time frame remains the board's highest priority. So in other words, it's basically telling us if inflation looks like it's going to peak again, we're just going to raise interest rates until it comes back to 2 to 3%, reading between the lines, which I'm sure everyone probably knows by now. Inflation goes up, interest rates go up. So this is the monthly CPI indicator that we're referring to. So that 3.4%, before, when they made this decision last week, the February data hadn't been released. I'm sure they had access to it. So you can see December 2023, monthly CPI indicator is 3.4%. Then it's the same 3.4%. Don't know how they managed to fudge the stats to make it the same, 3.4% for January and now February. But that's where we're sitting at. So we're almost in that 2 to 3% bandwidth that they are targeting. We're not there yet. We still got a bit more pain left in the economy before we can get down to that. And people got to stop putting their prices up. So there has been some normality return back to the market. And these are the major changes. Now, this is to January. I didn't update this, didn't get a chance to update this with February. But this gives you an idea on where this inflation is coming from. And apparently, breads and cereals are 7.4% up. So the highlighted ones. Food products, 6.9%, 7%. And tobacco is going up by 10.7%. This is a contribution to the inflation rate. Then you have a look at housing rents. You're probably not surprised by that, 7.4%. In a lot of capital city areas, actually more than that. New dwelling purchases by owner-occupiers, 4.8%. And then the losers, which is good, prices are coming down. Holiday travel and accommodation, hooray, because that all just about doubled after COVID when everyone was traveling. So holiday travel and accommodation is going down, luckily. And the other one that's going up is insurance and financial services, probably with all the flooding and everything that we've had. Gives insurance companies an opportunity to bump their prices up and redo their maths calculations to make sure that they make their billions of dollars of profit from us all paying the premium. So that's where the inflation contribution comes from. So the headline inflation forecast looks like this, and this came from the monetary policy paper released just last month. So you can see it's on a downwards trajectory. It sort of matches what the RBA just said. They expect it to be in that bandwidth in 2025. So they've been a bit wishy-washy about where this could be. It could be the blue, so it could go up, it could go down further. So we don't know. We're all just trying to speculate on where interest rates are going. But all data sources point to one direction, and that is down. So that's a good sign for us. And then this data website also forecasts, which is Trading Economics, also forecasts that in quarter 3, quarter 4 this year, which I tend to agree with more than the monetary policy paper, is that we'll be below 3% inflation. So inflation expectations will tick below 3%. We're already at 3.4, so we're nearly there. We only just got to wipe another 0.4, 0.5, and we're sub 3. So I think it could happen at the end of this year, and I think that interest rates probably won't move until the RBA starts to see consistent inflation below the target, because if they start putting interest rates down, chances are people will go and spend money and inflation will peak again or spike. Then if you have a look at the United States, their inflation is very low. Now, I know the United States is not the Australian market and they operate differently, but we do have a lot of ties to the United States. And they look like all data's pointing in the one direction as well, which is down for them. And then if you have a look at other places around the world, they're all looking like they're all coming back down, which is great news. So we're all coming back down together. Australia normally, or has been traditionally, behind the US. So look to the US for a little bit of some forecasts on what's potentially to come for Australia. All right, so that again is from the monetary policy paper released by the RBA last month. So policy rate expectations all headed in the right direction, which is great. Then you got to have a look a little bit at unemployment. It's still pretty steady at 3.8%. At least it's gotten, I shouldn't say that, but it's gotten a bit worse since we bottomed out at whatever the bottom was, low 3%. So some normality is, if you have a look back at the graph between like 2014 and 19, you can see the unemployment rate's like around about 5%, 6%. It's pretty stock standard. So whether we're going to get to 5 and 6% unemployment in the next couple of years is a question on everyone's mind. Hopefully we can keep inflation within the limits and not have to shed a whole lot of jobs. Then you have a look at the forecast for where Unemployment looks like it's going. So it looks like it's slightly trending upwards. We might get to 4.5% unemployment rate. So there's some jobs left to be shed. And that's based on monetary policy paper as well. Then looking at some RBA stats. So I'm going to flood you guys with a whole heap of stats, and I will decipher them to tell you what I think these all mean in the market. Everyone's going to have their slight different opinions. But if you have a look at new loan commitments, we're lower, definitely lower than the peak, but we're still tracking okay. But you've also got to consider now we're in 2024. So have a look back into, let's say, 2018, 2019. The loan commitments were similar. If you have a look at the top numbers, and I'm just going to pick out New South Wales and Victoria because they do make up a significant part of the market. So pick those two blue lines that you see on the screen, have a look back a couple of years, and you'll notice that it's around about the same. But one thing that hasn't been considered, or that you have to consider, is that property prices generally across the board are going to be up 30, 40, whatever that number is, percent. So technically for us to be at the same loan commitments as we were 3, 4 years ago, we technically need to be like another 30% higher in terms of those loan commitments, which we're not really, with the exception of, if you look at Queensland's graph, that gold color, that's still up a bit, but that's reflective of property values, whereas New South Wales and Victoria are not. So our loan commitments are still pretty low, and that's probably not surprising to you because it is a lot harder to get a loan now than it has been over the last few years. And I think it's going to remain a bit harder to get a loan because of serviceability requirements, because of the bank's criteria. You need a lot more money now to be able to borrow money from the bank. But I think towards the end of the year, once we start to come out of this credit squeeze that we're in, and the banks confirm and the RBA confirms that the interest rate cycle has peaked, then that lending is going to be more freely available. So we're probably towards the end of the year going to see this start to spike up. But I think between now and the end of the year, it's probably going to remain pretty level. So once the banks start changing their policies and they start lending money more easily, then people go and get loans. It's pretty simple practicality of how this, like what the data feed is into this set. And then obviously that builds momentum in the market. It has that crowd effect where everyone jumps in and then the market starts rising generally overall. Then we see more people getting loans because properties are going up and everyone wants to be a property investor. So that was for owner occupiers, this graph, just one comment. And this is for investors. So investors are hot in the market at the moment, or they're a lot hotter than owner occupiers. You can see the top two are Victoria and New South Wales, which I'm actually a bit surprised by that they're going up as well. Queensland is going up and WA is also going up. WA is going up probably more from interstate buyers than local buyers. So you can see all of those trends are all on the upwards trajectory. And that's for investor housing. Owner occupiers are pretty flat. Dwelling approvals by type, we're at a really low dwelling approval number across the country. I'm not going to go into each individual state. I've looked in particular at Southeast Queensland because that's where I'm developing. And in Southeast Queensland alone, the last 3 years, we have an undersupply of 30,000 dwelling approvals just in Southeast Queensland, to give you an idea. So we are tracking, or we are about to experience an even lower level of construction and building off the back of the approvals. So you've got approvals in one hand, and then those approvals need to get built. And there's a lag time between approvals and then the actual construction. So if approvals are low, which we're seeing here, it means that construction over the next 6 to 12 months is going to be very subdued, which is not great for our economy. We're likely going to shed jobs in that industry, or at least free up a lot of people. So it's going to get a lot easier to build a property. We're going to have builders pricing more keenly. The materials are not going to go through the roof like they have been. Labor is going to come to some normality, as in the cost of labor to build a house. So that's coming. But then on the flip side, where unfortunately we're bringing in a lot more people, and that number, and this is to September 23, we're bringing in a lot more people, and unfortunately we actually need to build more stuff. So we're going to have an even bigger problem than what we already have with vacancy rates and with people trying to find rental properties. So these numbers are from September 23. These are the latest numbers, which were only released, I think, at the start of this month. So you can see the total growth, 660,000 people. And then the net overseas migration makes up a significant portion of that. And all the other people having babies makes up 111,000. So this has come from the ABS, Australian Bureau of Statistics. And what that means for annual growth from basically capital city or state to state is, if you have a look at New South Wales, and these are just the overall numbers. So you've got the light blue is a natural increase, the dark blue is a net interstate migration, and then you've got net overseas migration as the gold color. So overall, New South Wales gets 185,000 people, most of which go into Sydney and surrounds. Victoria gets 195,000 people. And these are latest stats for the last 12 months, by the way, till September 2023. And then Queensland, 145,000 people, closely behind. South Australia gets 30,000. Western Australia gets 90,000. So they are the annual population growth that we're currently tracking on. It might be a little bit softer in the next 12 months if they ease back on migration, but that's what we're tracking at the moment, with pretty much the lowest building approval level we've had in the country for over 10 years. So it's a bit of a scary time, and it is going to be scary for the next 12 months with finding properties, and also finding properties to live in, but also finding properties to actually buy, because there's going to be not that much available because we're not building enough. The other part of the equation is, with property prices, is actually savings ratio, and with interest rates, how much are we actually saving? So in the last little bit, because interest rates have gone up, everyone's put more money onto their loans. The savings ratio has dwindled right down to 1%, as you can see there, or just over 1%. And it's forecast to climb or go up slowly. And when interest rates do start to come back, which I think will be in the back end of 2024, hopefully, they might get bumped into 2025 to start reducing interest rates. But once that starts to happen, obviously our savings ratio will go up. And also with some subtle wage growth, in other words, we're getting paid more money, that'll slightly increase over time as well. So this is what the forecast is. We'll get back to some normality maybe next year sometime. We might get back to the levels that we saw before everyone went crazy over COVID. So we had this big spike, and then we had everyone spend money, and now not many people are sitting on a lot of money. So now we're going to get back into that savings category. So let's have a look at, and I'm going to show you a graph on the next slide about distressed property or distressed mortgages, because there has been a lot of talk about distressed mortgages because the interest rate's gone up so much. People have come off fixed rate terms, and their interest rate has basically doubled overnight when they've come off that. So this is from a Ray Morgan paper just released recently. Sorry, Roy Morgan, not Ray Morgan. So mortgage stress, so percentage of owner-occupied mortgage holders. So this doesn't include the investor mortgage holders, but you can see if you have a look at 2007 and you compare 2007, which was the last boom bust or massive boom bust, compare that to January 2024, where we're basically in now. We're approaching those levels, which is extremely at risk, that red, according to these guys. Roy Morgan, they seem to be a little bit lower than what some other people anticipate. And then you've got the at risk, the gray. So we're 31% at risk, which is similar to the GFC or just before the GFC. Now, I'm not saying we're going to have a GFC. We're in very different territory to that. But there's obviously a lot of people hurting with their mortgage, owner-occupiers. And I mean, why wouldn't you be if the interest rates just doubled and you thought you were safe and you were putting away savings? The only way really to keep up with mortgage repayments, if they have doubled and you had, maxed your serviceability, is really to earn more income to try and pay it down, or to sell the property and not have the mortgage. So that's what these guys think based on their data and forecasting, where they think mortgage stress lies. And then if you have a look at number of mortgages at risk, so you have a look at interest rates, assuming 4.6%, and you have a look at the percentage of the population or mortgage holder population. So we're looking at like 31%. So about a third or almost a third of the mortgage population, mortgage holder population is at risk, but there is some relief coming. So we just need to, people need to hang on for a bit longer. And also the other thing about Australian property, very different from the US, is that we have what's called safe lending practices. APRA brought it in, which basically means the bank can't repossess your property tomorrow. If you fall behind, the bank will work with you, and they have to work with you by law. They can't just repossess the property and sell it. So we'll never have a massive crash in the Australian property market. We might have a sell-off if people get desperate to sell, but we're never going to have a massive crash with bank repossessions. So keep that in mind. This article, I thought I'd show this because this was hanging around 12 months ago, talking about half of Australian mortgage holders under financial stress. Now, I've just showed you those stats, which I believe are a lot more accurate than a headline to say that half of Australian mortgage holders are under financial stress. I tend to agree that probably 1 in 3 are under some sort of stress, and this is from February last year, and obviously interest rates have gone up since then. So it gives you a bit of an idea. I won't talk about that too much further, but don't read everything, or don't believe everything you read. Different suburbs are going to perform differently. First-time buyers markets where people max their borrowing capacity 2 years ago are going to perform very different to like an inner city market where there's not much debt on properties. So distressed listings, and this is the yearly change to February 2024. So the biggest number of distressed listings, New South Wales and Victoria, that looked exactly the same when I looked at this at the end of last year as well. New South Wales and Victoria were leading the pack. And then Queensland, Western Australia and South Australia. So negative numbers is good. That means that there's less distressed listings. So all those areas, because of property prices going up, we're in boom cycle for Queensland, Western Australia and South Australia. Distressed listing numbers have gone down. They've gone the opposite way. And then you got ACT and Northern Territory with a few different numbers there. So Northern Territory, don't go and buy a property there. It's a huge amount of distressed listings, 37%. So basically Queensland, Western Australia, South Australia, pointing to some good news. And I'm going to take that a bit further and show you some boom locations later. Total property listings. And this just mimics those distressed listings as well. If you've got a market where it's transacting properties really quickly and they're not sitting around long, there's generally not that many distressed listings because people can list their property and it can sell in 30, 60 days. Whereas if you've got a market that's running really slow and properties are taking 3, 4, 5 months to sell, well, then there's going to be a lot more distressed listings because properties are going to be sitting on the market, people are going to be dropping their price, and there's less buyers around. So total property listings normally go hand in hand with those distressed listings I just showed you on the last one. So Sydney and Melbourne, you got increased property listings. Now this is overall, different suburbs are going to perform differently, of course. But overall, Sydney and Melbourne, they got more properties on the market. Brisbane, Perth and Adelaide, they got a lot less properties on the market. And then you got Canberra, Hobart, a lot more properties on the market in the last year. So that's to January or February 2024. So that's a yearly change, the column on the right. Then you have a look at weekly rent listings. So weekly rent listings across the country are quite low, and the worst performer for that. So in other words, if you're an investor and you own a property in Perth, doesn't really matter where you own it, you're going to be able to rent it out pretty quickly. So Perth is at an extremely low level of listings, and I'll show you through some vacancy rates as well, which mimic that graph. So this is nationally. So nationally, we're at like the lowest level we've ever had on record in terms of vacancy rates. So how many properties are available to lease. And then if you have a look at the worst ones of that pack, Perth is at one of the lowest vacancy rates that it's had. So just one thing with Perth, which I know a lot of people are investing in Perth, and it has performed exceptionally the last couple of years. And I still think that overall, it's probably got a good 9 months to run. And I think some suburbs even have longer than that, providing that the iron ore market doesn't fall out and the price of coal doesn't fall to the floor. I think Perth has still got a bit more left in the tank. But if you have a look at the graph and you rewind back to 2012, 2013, Perth was almost at the same low level of vacancies. So Perth now has hit a number that's below that. But what happened after 2012 was the price of coal dropped, the price of iron ore dropped. And as much as people want to think that Perth has other industries, and it does, I'm not discounting that, Perth is heavily reliant on mining. If an iron ore mine or a coal mine goes and lays off 1,000 people or 5,000 people, what ripple effect does that have? And generally, it's at least a 10x ripple effect, because most people that are working in those mines are local to Perth, and they bring that money into Perth, the city, to spend it. And that spending of the money creates other employment for people. So if you just take a 10x factor, and I've read some reports where it's even up to 14, so up to 14 extra jobs are created from one mining job. So if a mine goes and lays off 1,000 people, that could be 10,000 people that it's laying off. So all of a sudden there's 10,000 people that are affected by one mine shutting down a section because the price of iron ore has fallen through the floor, or the price of coal has dropped. So Perth could experience that. And with China now slowing down, there might be some pain for Perth on the horizon. I could be completely wrong about this, but if I was investing in Perth now, I would be sort of anticipating that the market might go really well for the next 9 months. And I'm going to show you some stats around some booming suburbs that are still doing really well there. But I think just tread cautiously with Perth. That's my opinion, because it basically acts as a big mining town. It's not like the east coast of Australia. So that's my synopsis on Perth. Really low vacancy rates. You can rent if you're an investor, you can rent your property out the next day because there's virtually no competition, and you can ask a premium rent for it. Adelaide, exceptionally low as well. One of the lowest levels they've had on record also. And Brisbane is quite low as well, but they're the two winners. So I'm giving you a whole lot of data. Hopefully it's sunk in for those people that have just joined in the last little bit. You probably just clip the tail end of that data, but I will make this available to my network. So if you want to just jump into the social media platforms, I will share a link with this live session there later. If you did miss out already, or if you want to leave early and want to catch up on it over the weekend. So let's jump into the next section. I'm going to start to talk about the property market cycles. I started to talk about Perth a little bit, and I probably got carried away, but I won't spoil the fun for you with Perth. I want to talk about the property market cycles and how they actually work. This is a massive myth with so many people. You got these pretend gurus that say there's a 15 or 18 year market cycle, and they've tracked it back through history, and they're predicting that it's going to boom now, and then it was going to bust in COVID, and that was the mid-cycle slowdown. And they predicted it because they knew the 15 or 18 year market cycle because they read a book on it. So I'm completely hanging crap all over that. We aren't ever going to repeat history exactly. History does leave clues, but you can't rely on some 18-year cycle thing that is as gospel, because every market performs differently. Like, who could have predicted that the market performed like it did straight after COVID? Because we've never had a COVID-like event around the world. We've never been so connected to each other around the world as we are now. We've never had cryptocurrency. We haven't had like all of the same impacts that we're having now with China slowdown, US slowdown. We've got the wars. We've got a massive undersupply. Like, when has all those things ever happened in history? It hasn't. But what you can look for, especially with property, is that it almost performs solely or uniquely compared to other asset classes. When people have money and borrowing's easy, then you have this upturn. So when people can borrow money from the bank to go and buy property, everyone goes and buys property because finance is easy. And you have this upturn, and then we go into this boom. So we've just gone through that for the majority of Australia. And look, each suburb performs under this cycle separately. So you can literally be in a boom cycle in one suburb, and we've just seen it. Perth over the last few years has been in a boom cycle. Sydney, Melbourne has been in basically a bust cycle overall, that is. Not talking about individual suburbs. But you can have different suburbs booming and busting at the same time. Even after GFC, I've done analysis on different suburbs that were booming straight after the GFC, when most other areas were actually falling back in value. So you got what's called an upturn and boom. Then you get a downturn, which goes into a stagnation, and then an upturn. So generally, the upturn and boom last for 3 years. Now, this is a rule of thumb. This does change. Over COVID, this upturn for a lot of markets actually got cut short at about 2 years. And then we went into the downturn. And the other part about the downturn is because property is heavily financed, it does rely on finance. If the bank decides to change their policies overnight, basically we've created somewhat of a downturn, because you might rule out 100,000 buyers in the market because the bank now changes their policy and there's a credit squeeze. So money adds to the ability for people to buy property. If people can't afford to buy property, if they can't borrow money, then it's going to limit how many buyers are in the market, whether people want to buy property or not. So then the downturn generally lasts for 2 to 5 years. Now, generally, I say this generally because if you have a look at Perth cycle, for example, that lasted for 10 years. So their downturn basically over the entire city lasted for 10 years. And that was pretty typical on a lot of regional areas as well. So if you bought into a regional area, and I got stuck with a property in a regional area as well, so I experienced 10 years of downturn, and I waited almost 10 years for it to go into an upturn. So if you do buy regional and the market's booming there and you get in, pay too much, you could potentially have to wait another 10 years for that to recover. Now, that's likely not going to happen in the next little bit based on undersupply. But if you understand these boom bust cycles and you understand this, that the timing of the first upturn boom is 3 years and the next downturn stagnation is typically 2 to 5, you'll be able to pick the market cycles a lot better than some guy pouting an 18 or 15 year market cycle thing. So question about the 18.7 year cycle. No, I definitely do not believe in the 18.7 year cycle. I believe in research done by a leading statistician and economics firm, which produced this graph, which I've studied heavily. And I rely on a mentor that I had who was a valuer who taught me a lot about property economics. So no, I don't rely on some guy pouting an 18-year market cycle and has traced it back all through history, because each suburb in property performs very differently. And unless you own a major share of Sydney's housing market, which nobody ever will, then you can't rely on that or really anything else other than the market cycles. And just the theory behind this, just to take it a bit further, what normally happens during an upturn and boom is we actually go through a construction boom. So we have a period of undersupply, and then we generally go through an upturn boom for 3 years where prices go up, whether there's a construction boom or not. But generally we go through a construction boom, and that's what we're about to experience in a lot of places around Australia because of the undersupply. And that 3 years of that construction boom normally will oversupply the market at the end of it. So it takes normally 3 years for developers to go and build too much stock and then oversupply the market. And then we have a downturn stagnation. And generally, the banks will then change their policy after that period of time because they think that the market's going to crash if it keeps going too much longer. So the bank does control the lever quite a bit, and developers also control that lever also. And then the downturn stagnation is normally when the the demand catches up. So that oversupply normally gets filled, and then we go through an undersupply period. The banks need to start turning on a tap again to lend people more money, and then we go through the same cycle again. Now, the downturn stagnation for a lot of capital cities, that doesn't have to mean that prices drop by 10 or 20%. That can just be that prices level out to zero. And when prices level out to zero and we're running at 3-4% inflation, we actually have real property prices going backwards. So here's my top boom picks for the Australian market. And I analyzed these last year, and I wanted to just show you the ones that I picked last year. They're still performing okay. There's some new ones that have hit the list. There's some other ones that I didn't talk about, but this is Banksia Grove, Western Australia, upswing market. This is what I said in November 2023, if you have a look at the last live that I did. And then in February 2024, and the market's gone up more than this, but if you go from November to February, so call it 1 quarter, you could have made 50 grand in this suburb. So have a look at the left-hand buy price, 529 to 572. So that was my pick back then. I think this market still probably got longer to run. To be honest, this is the graph of the growth. So you can, if I take that boom bust cycle, you can see back in 2020-ish. So if you take like, late 2020, it started to go through the boom cycle. Now it's lasted for about 4 years, or that's at least what it looks like. But it also, if you have a look at the volumes through there, you could probably say that it actually went through a period of stagnation briefly between 2022-ish, when interest rates started to rise around that period of time. And now we're probably in that 3-year boom window again. So if you take that 2022, we might see the suburb boom for another 12 months, but it also depends on the greater Perth market. And Perth is very finicky as well with the industry, mining industry. So look, the suburb might boom for another 12 months. It might even keep going thereafter, but I still think there's some growth left in here. And this is a couple of the stats. So from November 2023, so if you have a look at stock on market, inventory, days on market, and vacancy rate, so those 4 stats, there are others that I'll look at as well, but obviously I don't have time to go through all those. So the stock on market, the left one, that's gone up slightly. So there's a bit more stock on the market. There's a bit more inventory, but it's less than 1 month worth of inventory, basically stock to sell. Days on market has actually reduced. So property selling quicker than what it was in November last year. And the vacancy rate has basically stayed the same. There's virtually no vacancies in this area. So I think that's a strong market. I still think it will perform or continue to perform strong. But again, like I said, with Perth, if we've got mines that start laying off some significant numbers of people, we could see a lot of mass exodus from Perth, because there's nothing else around Perth. So they got to do a mass exodus, and they will probably come over to the East Coast in search of work. So then you got Wellwood, Western Australia. So I said in November last year, upswing market with uplift to build new. So this is a more of an urban growth area with new builds, new land being released. And some people don't like these areas. Some people love them. I think there's areas to get into, which is on the urban sprawl. And I think there's some areas that I wouldn't touch. But it all comes down to the specific area. This is just an overview. So I said in November 2023, I think this market's going to do okay. It's gone up by a similar number, like 50, 60 grand in that time. Rents have gone up. Yields have basically stayed the same. And this is the graph here. So you could probably say that it entered into the growth cycle probably around about 2021-ish, maybe mid-21. So if you just take that 3-year plot, it's 3 years, give or take. That's a rule of thumb. So we're probably going to see this market grow for another 12 months, I reckon, maybe at the end of the year. It may not go any longer, but that just depends. So you could jump into this market now, make 9 months of capital growth, and see how the market's tracking at the end of 9 months. We all try and have a crystal ball, but really we're all just trying to anticipate what's going to happen. So I think that market's still got a bit longer to run, maybe the end of the year, maybe longer. And these were some of the key stats. So stock on market has basically stayed the same. And you can see the stock on market, the listings are a lot higher there, but obviously it's a bigger suburb. Inventory, that's climbed slightly. So there's obviously more people building new homes in that area. So you've got a slight uptick of inventory. So what you don't want to do is be in an area that then goes into oversupply. So you got to keep an eye on that for growth corridors, but you got to look at what's coming up out of the market over the next couple of years. Days on market, now that's jumped from 37 to 61. So that's telling me that more stock is coming to market, and maybe this market is actually slowing down. Or with more stock coming to market, where's that demand coming from? Is this a new upcoming area? Is the supply over this whole suburb? Is it still reducing as a suburb whole? But this market looks like it's trending up, but it was only a spike in the data, just to let you know, because I did double check this. And then vacancy rates are still extremely low. And there was uplift to build a new house in this area as well. So in other words, if you buy a block of land and build a house, if you do it the right way, I'm not saying every person's going to make money, but if you do it the right way in this area, which is Wellwood, for those people that missed it, I think there's money to be made for a little bit longer. Forestfield, WA, this is my pick of upswing market. So it's close to the city, near the airport. Yes, you got airport noise. Yes, you got different houses and different demographics and all that stuff, but it looks like it's going through another boom cycle. So you got a buy price, which is 582. Your yield's pretty up there. Again, it still comes down to the individual property that you're buying. Keep that in mind. So that's the graph there. looks like we went through a bit of a stagnation, and then it looks like it's going through an uptick again. And I think this area might have a bit longer to run than the end of the year. But again, my crystal ball, I think, doesn't go much longer than that with Perth, unfortunately. But this suburb might do another 1 year growth, maybe more. Then Westminster, upswing market. So it's north of the city. So buy price is 515, rent's 452, and then yields about 4.5%. So it looks like it's gone through, or started to go through that upswing and boom cycle from about early 2023. So again, we could see another 12 months, maybe 2 years of this market in upswing. So I think that will do okay. Then over to South Australia. Ranella and Morphale, I think, will do well, or I thought that back in November. I even did a video on Ranella and Morphite in like the start of 2023, and I said these markets are going to do really well. I have students developing in these areas and buying property in these areas, and it actually did do well. It's still doing well. So this is the graph for that. So it's on the upwards trajectory. Now, it doesn't really fit that boom bust cycle, but it looks like it's still going to go well. And if you have a look at the November, when I said it was still going okay, to February, it's done a little bit of growth, not as good as the other ones in WA, but it's done okay. It's still ticked up by 40 grand according to the typical value. Now, just one thing about typical values, because I'm only looking at the whole suburb. You're only buying, you as an investor, you're only buying one property in a typical suburb. Your one property could outperform the typical value, or it could underperform it. So if you look at an area or suburb like this and you think, okay, I'm just going to buy something of realestate.com, you may not perform the same as these stats. You actually might perform better, or you might perform worse. So each property is going to be slightly different. And I've had properties that have outperformed the market, even in a flat market that's not growing. So well outperform the market. So don't just think you need to buy in these growth areas. You can still buy property in areas that have minimal growth or marginal growth, and you can still make a whole lot of money. So November 2023, I said this area looks like it's still got some legs. It's still going to go for a bit longer. South Australia, many parts are in that bust cycle or in that stagnation. They're not really doing anything. So this one had about 40 grand growth over the quarter. And then if you have a look at stock on market, like the stats, the data on this still looks really good. The days on market have slightly upticked, but they're still really low. There's 30 days on market. That's not much at all for properties to be 30 days, especially in South Australia. And the vacancy rate is still exceptionally low. So then my Brisbane suburbs, my favorite area, especially now, because Brisbane is in overall, I've had a look at heaps of suburbs around Brisbane. Most of them mimic Bracken Ridge, or Bracken Ridge is a bit further progressed, but Bracken Ridge is going to do well. So I said last November, it was stagnation into upswing. So you can see it's basically done nothing since 2022, mid-2022 to around about late 2023. So it just started to uptick in November last year. It just started to get a little bit of growth. And I said, I think it's going to be stagnation into growth phase, because it's just on that upward trajectory. And I think Brisbane overall, you could just about buy blindfolded here in the next 12 months and make money. So it's a bit of a higher price suburb. Yes, Brisbane has ticked up. So in November, typical buy price 769. Now it's like 800 typical price. So it's gone up a little bit. It's not in that hardcore boom phase, but I think it'll do pretty well. So November 23, there's basically no stock on market, 16 listings. There's less than 1 month of inventory. Days on market was 32. Vacancy rate was 1.27. So that's pretty much stayed the same. So you keep plodding along at those low stock on markets, low inventory, low days on market, low vacancy rate, just to pick out 4 main data stats. If your suburb keeps plodding along on that, once more affordability starts to come into the market, in other words, banks lending more freely, interest rates start dropping, more demand coming in from interstate migration, overseas migration, these numbers in terms of values on the properties, they have to tick up. There's a supply and demand imbalance, and the numbers will tick up over time for these markets. They're just starting to come into that boom cycle. And it's very typical for a lot of suburbs around Brisbane. Now, a lot of them are higher priced and they've got lower yields, but if you're smart about your buying, you can still buy stuff in and around Brisbane City at like 4 or 5% yield. Some people might think I'm kidding with that, but if you're in an area and maybe you got a lower budget as well, just on that, like Tingalpa or Bracken Ridge, which I just showed you, if you're in areas and you don't have the budgets that these areas, like, an $800,000 for an investment property, have a look at what the value proposition of the house versus like a townhouse. I don't particularly like units. There are some units that I think are exceptional buying, but there's too many rules with people buying units and most people will screw it up. So just to keep life easy, I do like terrace homes or townhouses where they've got land component. And if you're in an area that might be $800,000 for a typical house, but you can buy a townhouse for like half that price, like there's a big pricing disparity and you can get that rental yield up, then chances are that pricing disparity will close. That's not given, of course, but there might be a value proposition in you buying something that's lower value, like $400,000, $500,000, that's got a land component closer to the city, instead of like buying somewhere that's regional that might be in a boom cycle now, and then it's going to go through a bust cycle pretty soon. So I do like Brisbane, and I think a lot of areas are in this stagnation into upswing. So you can see this area, Tingalpa, it went through a nice boom in mid-2020. It ended really early, like 2021. Now, a lot of the boom cycles were cut short, I mentioned before, because COVID, we went down and then we went up really quick. And then this is just plotted along for a little bit longer. And I think in the last quarter, it started to go into that upswing. So I said that last year. So have a look at the buy. The buy in November last year was $867. Now it's at $928, typical buy price. The rent's gone up. The yield, yes, it looks low, but if you're smart about buying, this is just typical values. You can still achieve, like I said, like up to 5% yields if you're really smart, but even half the stuff off the shelf, it's like 4% now, 4.5%. Supply, so you got really low stock on market again, like 0.43%. You got low inventory, 1.5 months of inventory. Tingalpa has some new stock, as does Bracken Ridge. So you've got some new stock entering the market, which I like because it regentrifies the suburb. When you've got new stock coming to market, build prices are higher. It means it puts upwards pressure on existing homes. Days on market, have a look at where they were before. They were 42 days on market, and now they're apparently 16, which is crazy. And vacancy rate has dropped substantially. So in November 23, I said this market looks like it's in stagnation and it's about to go into boom time. And it has done that literally in that last quarter. So if you had followed my advice, pretty much on every suburb that I said, you could have made money, just about blindfolded. But I do still think this area has more legs to run. But if you're buying in an area that's now got only 16 days on market with hardly any stock on the market, it is going to be hard to get into those areas, and you got to be smart about your buying. And I think when we are in like boom suburbs, being smart about buying is literally buying a property as soon as it lists on the market, or getting stuff off market before it lists. And definitely not using a buyer's agent. For all due respect to buyer's agents, they love to get stuff off market that agents are too lazy to sell all the time. But if you're smart about buying in a boom market, off market, one like this, you can still pick up fantastic opportunities. And I think there's another 2-3 years to run in these suburbs and a lot of other suburbs around Brisbane. So that's it from my boom picks. Look, there's heaps more. I was going to do a list, but I thought I'm not just going to give away all the secrets because, and I don't want you guys to buy blindfolded in these areas thinking that you're definitely going to make money. You just about could, but I want you to do the work yourself and buy an exceptional property. Don't just go into there, go on realestate.com and offer the best price and then buy the first property you see. So the bonus in this is how I made $53,000 in my lunchtime. I've had a lot of people ask me about renovations, a lot of people interested in renovations. Just before I jump into this section, I'm going to catch up on the questions because I noticed there's a few building up now. So just before I jump in, I'm going to backtrack and I'm going to go to, okay. All right. Yes, I don't talk about Melbourne because most of the suburbs in Melbourne are in stagnation. I think Melbourne will do really well, probably next year, maybe the year after. I'm actively looking in Melbourne for developments, but I do think that there's going to be a bit of a lag time for Melbourne to catch up. So I also don't particularly like most parts of Melbourne because the rental yield is so low. If you compare Melbourne with Perth, South Australia, Brisbane, you can get a much higher rental yield. I shouldn't say way higher. You can get a much higher rental yield in Brisbane versus Melbourne if you want to stick to the East Coast and high immigration. And I personally prefer Brisbane. There's just a lot more going on. We have really low stock levels. We're going to have really low stock levels into the future. So I'm not a massive fan of many parts of Melbourne, but I do think it'll have another good run in the next couple of years in certain pockets. What site is the data from? If you do the SR method course, I'll show you what stats to use and the platform that I use, but I might share the platform. But it's not about the platform and it's not about the data. It's actually about how you interpret that data. So anyone can punch out data. You can get a whole lot of free data from different places, but it's your interpretation and your understanding of the data. So I can share the site with you, but I honestly don't think it's going to be of any benefit unless you truly understand what you're actually looking at. All right, somebody agree with me. Awesome. I can't see who you are. It just comes up as Facebook user because this is over multiple platforms. Where to buy in Brisbane in the current market? Nilesh. Yeah, I've given you a couple, but I'll let you guys do your own research. But I do think you'd buy just about anywhere in Brisbane blindfolded at the moment and make money in the next few years. Yeah. North of Brisbane, Moreton Bay. Yes, I definitely like north of Brisbane and Moreton Bay. I'm heavily invested in that area. For those people that don't know, do I like Granny Flats? I do sometimes like Granny Flats. The only issue with Granny Flats, one, they do produce really good income. If you just plonk a Granny Flat on a property, and it might cost you 100 grand or 150 grand, whatever. But the only thing about Granny Flats which sucks is the bank undervalues them. So you might be producing another $500 a week from a Granny Flat, and it might have only cost you 100 grand. So that's a fantastic return on investment. But the bank, because when a valuer, you've got three different types of valuations. And unfortunately for residential property, they use the comparison method, which means that if you've got a 4-bedroom house, they'll go and look at all other 4-bedroom houses that have sold in your area over the last 6 months. And there's not going to be too many properties that have Granny Flats to compare to. So what they do is they basically don't even consider the Granny Flat or the cash flow you're getting from it. So unfortunately, Granny Flat may not increase the value of the property, but it will generate you extra income. And there are times where it's advantageous to do it. You just got to weigh that up in the market in the suburb that you're in. So in other words, you don't want to spend 100 grand of your cash on the Granny Flat only for it to be then stuck, like 100 grand stuck in that property, and not be able to refinance it back out. But it might solve a problem. In other words, it might solve a negative cash flow problem, but you still need to get the money from somewhere to be able to build the Granny Flat. And unfortunately, you don't have a whole lot of comparables for the valuer to compare to. So they normally discount the Granny Flats, which is unfortunate. All right, next question. Do I like a unit strategy? In terms of owning units, I think that some units are fantastic buying and they'll get fantastic capital growth. Just have a look at like luxury units, for example, but I don't think like a luxury unit is a great investment. And when I'm talking about luxury units, I'm talking about like maybe Gold Coast luxury units or Sunny Coast luxury units. You know, if you had bought one of those over the last few years, you would have done exceptionally well. But generally, you've still got to hold that, and you obviously need a lot more money. With units, I think generally, if you're buying a unit, you want to be buying in a really small complex, like a boutique complex. So low body corporates, low number of owners. You want them hopefully to be mostly owner occupiers, especially if it's an investment. So owner occupiers, like everywhere, they look after their place a lot better than what renters do. The main thing with units is pricing disparity. So the difference between the cost of a unit compared to the cost of a house, and what does that pricing disparity look like? Because most people won't elect to live in a unit if they can afford a house. So you got to really understand the market. And generally, I don't like units because you've really got to understand how the market cycle works, but then also how development works with units. So units, I think, are good. Small complexes, So boutique complexes, massive pricing disparity between the next jump up, in other words, houses or maybe a townhouse, and low body corporate, and uniqueness. So you don't want to be in an area where you're buying a 2-bedroom unit and they're building 1,000 around the corner. And you can be in an area, say, for example, you're in one suburb and 2 suburbs over, they're building 1,000 units. Generally, renters, if they're renting an apartment, they're not going to be that fussy on location. So if you've got an oversupply of 1,000 units, a couple of suburbs away, chances are that's going to have a ripple effect with oversupply. Unless you've got some uniqueness to your property, your unit, then that oversupply will actually affect the value of your property, and then also it's going to affect the rental yield. So the amount of rent willing to pay for people willing to pay. There was one time in the market in Brisbane where there was a whole lot of units that got built in Hamilton, for those people that know Brisbane, and also Tenerife for that matter. So, close to the city. Tenerife is only a couple of Ks away. Tenerife, Newmarket, a couple of Ks away. Hamilton's probably like 4 or 5 Ks away from the city, but huge amount of unit construction over 3 years, 4 years. So at one point they were offering a month's free rent on these units, and they were renting out like 2-bedroom, 1-bath units for like something like $350 a week or $400 per week. Like, it was ridiculous. It was like crazy. I was actually shocked. It's because they had so many units already vacant on the market, and then the developer just kept going. So I think it was like Brookfield Multiplex Development Corp or whatever, and they just finished like 500, and then another developer had finished 200, and another developer had finished 300. So you literally had like 500 units coming to the market in one hit, and there were already all these other units sitting on the market. So all these investors, which were probably overseas, interstate, all the project marketers all flogged all these units, and you had this big glut of units come to the market, and then literally the owners had to offer a month's free rent and like $350, $400 a week for a unit. And that wasn't that long ago. And that was straight after the construction boom that we had. And that's normally how the market works, especially with the unit markets. So if you owned one of those units, not only did you drop like 20 or 30% in value on that unit, you also had to drop like 20 or 30% on your rent, and have basically no income coming in for a period of time. So I generally don't like units. And then what that does is, though, that market, because they're all new units, that market actually flowed out to other units in the area. And then it even flowed out into houses, because the rent was so cheap on the apartments. People weren't actually renting houses at that point, because if you had the option between a unit that was like half the price of a house, you're going to pick the unit, and it's like a brand new unit that's never been lived in. So anyway, just consider that. Melbourne, I watched all the cranes in the sky over the last 5-6 years oversupply and flood the inner city market. I haven't looked at it recently, but I still believe it's still oversupplied, that inner city Melbourne market with units, and they just went crazy with their amount of cranes that were in the sky. I mean, you can see the wave coming. You just have a look at all the cranes in the sky and see how many units are getting built. Just count the number of cranes and just think about how many units they're actually building and what the makeup is of that. So that is coming, by the way. For those people that haven't realized, we have to have a construction boom around the country. We've got an undersupply of stock. So that wave of cranes in the sky, that is coming. I thought it was going to be next year, but based on those building approval levels, it's probably not going to be next year. It's probably going to be the year after that we're going to see a heap of cranes in the sky, and then we're going to go into oversupply in those unit markets. So just be careful. I think there's money to be made in the unit market before it goes in oversupply, but you just got to be really particular about what you're buying. All right, unit strategy, did that one. I won't spend too much longer on this. I'll save some more questions for the end. When would I buy a house in my own name? I would buy it in my own name if I was getting the first home owners grant and I could take advantage of it. I would do it in that regard. Now, I'd only put it in one person's name if I could, but there are rules where I'd put it in two if you need joint incomes, but you need to be a bit smarter about that. And you also need to realize that if you max your serviceability, your borrowing capacity, you're going to have to sell that property, or you're going to have to make more money to then go and duplicate and buy another property. And also, I like structures. If it's your first home and you can stick it in a structure, sometimes it's more advantageous, but unfortunately you will have to forego the first home owners grant if you qualify for that. So first home owners grant, I'd put it in my own name, or potentially if I'm not stuffing up my serviceability, you can take advantage of the tax breaks like I showed you in the depreciation example, And you can put, if you're a PAYG, so income earner, you can put a property in your own name. You get those direct tax benefits. When it goes in a company, then you don't get the direct tax benefits. You can get them indirectly, but I won't go into that detail. So there's a couple of situations where I would, but as you start to grow and build a bigger portfolio, you definitely don't put it in your own name. But most people, they go and buy, I shouldn't say most people, but a lot of people will start to build up that portfolio, and each property they add to the portfolio, they'll keep putting it in their own name, or they'll put it in two people's names, and they get to 2, 3, 4 properties, and then they go, oh crap, I've run out of serviceability. Now what do I do? And for a lot of people, they go, now what do I do? I've just got to sit and wait for interest rates to come down, or I've got to earn more money, or I've got to pay down the debt so I can get more serviceability. And it cripples you, because that's the time generally that you should be buying, is when other people are limited in their buying. All right, I'll leave those questions for a bit later. I'll keep moving, and then I'll answer them all at the end. All right, this is the bonus section, how I made $53,000 in my lunchtime through my renovation. Now, this renovation was nice and beautiful. Now, I did do this 10 years ago. I'm not doing renovations like this anymore, guys, just to give you an idea. But look, I started somewhere. So I did my first development, if you're on at the start, which was a 5-house development. And then I did I did about 12 renovations in a period of 2 years, including a single house build or a couple of house builds in that time. So I went back to doing single houses, and then I started to get into bigger properties about 6-7 years ago. I started to get into the 7-lot, 10-lot. Then I went crazy and bought about $200 million worth of stuff about 5 years ago. So this is the initial purchase. It was a brick house. It's completely ugly. You can say what you want about it, but this property made $53,000, and I probably spent 20 hours on it max, I'd say. And I'll tell you what actually happened. So the initial purchase, I had a strategy around turning up to auctions. So I'd turn up to the auction. I'd have whatever amount of auctions I had on the weekend, 4 or 5 auctions I'd turn up to on one day. And this was my strategy 10 plus years ago. So I inspected the property and I bought it the day of auction. So I had a 10-minute walk around. By this point, I knew the main things I was looking for. I knew the market that I was in. This was actually in Ipswich. I'll give you the address if you want to look it up. I was the only bidder because the property was poorly marketed. I found out on the day that it was a bank repossession. Now, a lot of the bank repossessions, they don't actually advertise them as being repossessed. You can look it up through different titles and all the rest of it, but this isn't necessarily a strategy that I think you should target. It's more about buying a property and being able to add the value to it with the renovation, and also buying in growth locations, so you can get the cream as well from the market growing. So the reserve was set at $180,000 on the day. I paid the reserve, which sometimes you can negotiate on the reserve. If you're negotiating with the bank, they can write it off. But in this instance, I either had to pay $180,000 or they were going to list it on the market, and they would have easily got, I think, 220, 240. So this is a really low value property. And this property is not worth this sort of money anymore, but it sort of gives you an idea of where I started. And you could be doing renovations in regional areas. I literally saw one the other day. Somebody bought it for 260,000. Less than 12 months later, I think it was 6 months later, they sold it for 460,000, and they probably spent maybe 80, 90,000 on the renovation. So don't just think you need to be buying around capital cities if you're just flicking, but you definitely don't want to be buying in a regional area where the market's dropping or about to drop. So there were a lot of little fix-ups with this, and the kitchen was unfinished, which was key to this one and a few of the other renovation projects I did. Now, I underline the kitchen was unfinished because there's a lot of banks, when you've got an unfinished bathroom or unfinished kitchen, they deem the property as being unlivable, and you can't actually get a normal valuation on those properties. So you need to get a bank valuation. How I got the valuation, and it was a desktop valuation done by the bank's automated system. So the bank I used to finance this was actually CBA, just one of the majors, and they have an automated bank val system where they pick up all of the data from surrounding houses and they just plonk a figure on it. And I paid $180,000 and it just valued at purchase price. They didn't need to know that the kitchen was unfinished, because if they send a valuer out, valuer says property's unlivable, bank doesn't lend money on it based on that. So on properties where they're missing a bathroom or kitchen, you can't send a valuer out. You have to do a desktop valuation. Just one little trick for you guys. I did this as a joint venture. So I did a lot of my early stage properties as a joint venture. For this particular one, I could have funded it, but it was more a strategic move where I actually had a joint venture partner come in and provide all of the capital. So I got a bank loan and then I got him to provide all the capital. So I did this with no money. I had enough money at this point, which was whatever it was, 10 years ago or so. I was working as an engineer, making hardly any money. But I had enough money to buy this house because I did it after I finished my first development. But I did a strategic move. I did a joint venture. That's what I did back in the days. I think it was a 50-50 profit split. And this was a project scope. So I finished a renovation in 1.5 weeks. So I made over 50 grand in 1.5 weeks. This was the before and after. So yes, the after, it still looks somewhat ugly, I think, but it looked a hell of a lot better than what it did before, like 1,000 times better. So we being not me, now just one key point with people doing renovations. If you are doing a reno, I personally did none of the work for the renovation. On my very first project, I actually spent too much on the renovation, and I found myself midnight on 5 days of the week sanding walls because we didn't have enough money to finish the renovation. And sanding walls at midnight after you just come back from a 12-hour workday is not fun, if anyone has ever done that or done something similar. And I vowed at that moment on my very first project that I would never do any renovation works ever again, and I didn't. I just absolutely hated it. It was not my forte, and I made sure I never ran out of money again either on a project. So I did this project 1.5 weeks. I basically gave it to a contractor and he did everything, and I just did the bit at the front and told him what to do. So we did painting, and you see everything got painted. The shed carport thing, external, internal. There were some internal touch-ups. The roof got done. Literally everything got coated with a lick of paint. So paint does wonders. If you think you can't paint something, you find a painter, they put a primer on it, scrape it down. You can paint just about everything. Cover it with a layer of paint. It looks fantastic. And it's the cheapest way to add value. So then there was some landscaping. So that grass looks a lot greener. So it got watered and it also got new turf on it as well. So general cleanup. Probably the only thing I probably could have did on this was probably put some plants in and made it look a bit more homely and had a bit more landscaping. General cleanup, and then you see there's no gate. I installed a gate. So that fence is all the original fence. It just got painted. The scope include some rear eaves and guttering fix-ups. So somebody had sort of half-baked this renovation previously, so it just needed to be finished. There was a downpipe drainage and roof fix-up. Relocated the clothesline, so it had the old Hills hoist thing. So that just got put on we just had a slim line. You can see rear garden cleanup and landscaping as well. You can't really see what we actually did, but there was a massive garden in the back that was like overgrown trees and things. We just got in there and just chopped them all down and made it look nice. And then the rest of the scope, the plaster internal laundry wall, which obviously I'm not showing you in this photo. There's plaster over some existing bathroom window, which I vaguely recall as some weird window in the bathroom. Internal roller blinds, new electrical fit out, kitchen splashback, AC fix-ups, electrical hot water, screen door fix-ups, skylight fix-ups, further fix-ups, more fix-ups. And that was the house through renovation looking like a bit of a mess. So what I did and what's key with renovation, especially when you don't want to do the manual labor work yourself, is you need to scope the project out properly. I have a checklist that goes through room by room. For those people that are interested, it is in my accumulator course. I have a checklist. I go through it room by room, and it just scopes out the whole project, because without the scope, you can't tell somebody else what to do. But the other part of the scope is you actually need to work with somebody who knows, like a builder, or if you've got a painter there who's going to know a little bit more, especially if you're not handy or you don't know about renovation. You just walk around with a builder and you go, what do I do in this room? Skirting boards, do I replace them? Do I fix them? Do I just paint them? And they're going to know. So you don't need to be the expert. You just need to basically write down the scope, and then you work through that scope with somebody. You give the scope to them, and then they can price it from there. So the scope actually looked like this. It was $16,000 worth of cost items in this cost schedule. And I got one company to do it all. I basically found a handyman company, and they did just about everything. Obviously, electrical they didn't do. And there was the roller blinds that they didn't do either. So you can see, I'll just run through the items. So you had carpentry, sheet weatherboard laundry, bathroom window, architraves, laundry window, clothesline removal, and install new clothesline, plumbing, laundry, to exterior waste. I think there was a waste pipe that wasn't connected. Pressure clean all external concrete surfaces, make it look nice. Pebble supply and install rear garden to remove weeds. That was that rear garden that was overgrown. Gutters, downpipes, flash fixing. So you can see all that stuff in the back in the photo I showed you before. Then you got paint external, including fence, paint internal, remove soil. Obviously, he didn't do that. So you had total there. And then the electrical, that's right. He organized the electrical contractor, not me. And then the tile supply and then the blinds. Oh, sorry, I take that back. Home shield was 13,684. And then those bottom ones was what I organized. So I organized basically 4 trades. So home shield, which was the handyman, electrician, tile supply, and then the blinds. That was it. So it was 4 people. And there's the blind quote. And if you have a look at the date on it, it's from 2014, literally a year ago to the day. Oh, sorry, 10 years ago, not a year ago. 10 years ago to the day. So that was the blind quote. Now, keep in mind, this is 10-year-old pricing as well. You don't get stuff done this cheap anymore. It's more expensive than this. You could probably add maybe just about double all those prices now, but it sort of just gives you an idea on this. And obviously the value of the property is a lot more now as well. So kitchen looked like that. Their tiles, interior looked like that. So it looked nice and fresh. Front of it looked like that. Then I appointed an agent to sell the property. In Queensland, we've got a Form 6. Other states have different forms. And the final feasibility looked like this. So 270,000 is what I sold it for. I've got sales estimate on there, but that was about the sale price. Less the purchase price. Then you got construction, contingency consultants, contribution costs, blah, blah, blah. So it was basically the construction was 18,000. Purchase, holding costs, and sale costs were 19,000. So it was 53,000 net profit before tax. So it was a 24% margin, and I turned it around in 1.5 weeks in terms of the renovation. Obviously, I had the sale thereafter. But what I did with this property, I actually thought I was going to keep it, and long term I could have kept it, but I decided to just take the money and run. I rented it for $320 per week. So if your strategy is to buy and hold property and accumulate multiple properties, if I had known about structuring back then, I probably would have kept this property, because what I actually did as soon as I rented it out, I actually pulled out all of the money that got put into it and I repaid back the investor. So literally within, I think by the time all that happened, that was about 2 months. So literally within a 2-month window, there was money that went in and money that went out. I was left with the bank debt, but the rent was covering the bank debt. And that's when interest rates were not at a too dissimilar level to what they are now 10 years ago. So I rented it literally 2 weeks after I settled it. I did the renovation in a week and a half, and it rented the following week. So it was a very good deal. It was one of the best renovation deals I did in terms of timeliness. I've done about a dozen renovations. Some of them taken a lot longer than that, but definitely not shorter. And I did that and just built up a lot of cash flow from doing renovations. So if you want to start off small and you don't want to do a big development, I think renovations are great. They are fantastic, but just remember, it's not the renovation that makes you the money. It's actually the whole strategy. So if you're on the tools and you want to get your hands dirty, that's fine. That's fantastic if you love doing that. But I did not like doing that. So I never got my hands dirty on a renovation. Mine was all about the strategy of buying it under market value, adding value through the renovation. Somebody else did the work, and then taking the cash and then doing the next one. And I typically would have, I think at one point I might have had 3 or 4 renovations on the go at any one time, and trying to manage 3 or 4 renovations. And I worked 80 hours a week at this point in time. I obviously had to be really efficient with my time. I actually used to track my time, and a typical renovation would take me about 40 hours to finish. So just keep that in mind. And that was when I was very efficient and I had done a number of them. But over time, I realized that there was a cap with renovations that I could do. And there's a ceiling that you hit with renovations because you do have to organize more contractors, and it is only a single house. So that was when I decided to go big and get into bigger properties, because I could get more scale of economy. I could spend the same amount of time, and instead of finishing 1 property, I could finish 10 in the same amount of time and make 10 times the profit. So it's just really where you're at. If you did like this is you can see how cheap this property is. Renovations now, like it's pretty easy to make 50 to 100 grand from a typical renovation in the market now, just with where prices are at, even with build prices as high as what they are. So, if you did a few renovations a year and there were a couple of weeks turnaround, you could make, $200,000-$300,000 a year fairly easily. But there is a ceiling, and I've seen other people hit that ceiling where they're working 60 to 80 hours per week, and their ceiling is about $500,000 to $1 million with renovation. So if you have a desire to go beyond that, you're going to have to get bigger. If you're happy with renovations and making that sort of money, you can definitely do it, but you do need to be strategic about what you do and scope the project properly. All right, cool. That's it on tonight. So I got in time, 1.5 hours. For those people that have been with me from the start, well done. If you did miss out on the start, you can have a look at it later. I am going to make the link available, and I will put this up live. So I'll make that link available on YouTube. So just to backtrack on a few of the questions, I actually haven't had that many about renovations, which is surprising. So many people have asked me about it. Obviously, I've answered all your renovation questions. All right, so many tier 2 and 3 companies going bust. Interesting, a few years ahead for the construction boom for tier 1s. Yes, predicting Brisbane Lions by 2 points. Okay, all right, they were the questions. Awesome. So I had more questions before. All right, for those people that are still watching, if you have any last minute questions, let me know now or forever hold your peace. I'll answer a couple more, and then I will call it a night and get on with Easter over the weekend. All right. All right. I've been looking online for builders margins, and a HIA contract is generally 20 and 25% margin, which seems to be common. Is this true? So most builders work off 10 to 15% margin. I do not like a HIA contract. It's very unfair towards the builder. Builders love HIA contracts because it favors the builder quite extensively. I think QBCC contracts are a lot more fair in terms of like a free contract. And you can generally negotiate a builder's margin of 15%. That's been my experience for a typical residential builder. They are happy with 15%. If they're not happy with 15% and they want more, I'd say just go somewhere else, because I think 15% for variations, or if you're doing a cost plus, for example, I think that's ample margin for a builder. If you do development, developers do make higher margins, but there's obviously more involved with development. There's more risk, there's loans, there's all that stuff, but developers do make more margin than the builder. So generally 15% for variations with builders on resi contracts has been my experience. Where are the renovations for uplift? So the biggest key with renovations is pricing disparity between an unrenovated house and a renovated property. So you can pick pricing disparity when you look at what's sold in the area. So you have a look at like a new property, for example, or a renovated property versus one that's decrepit. My experience has been not to do structural renovations. I have done a couple of smaller structural renovations, and by structural, I mean, that's when you start taking out structural walls and adding beams, basically just bigger renovations. Cosmetic renovations, so much easier, where you just give it a lick of paint, or you take out a non-structural wall. I've definitely taken out walls that have been non-structural. In other words, you don't have to worry about beams and engineering and stuff. So if you get in and do a quick cosmetic reno, you get it done cheaper because you've got less expenses, but you also get in and out really quick, or a lot quicker, so your holding costs are less. So I think if you're spending any more than about 6 weeks on a renovation, it's probably too long. And in that 6 weeks, you want to just have an army of people coming in and doing it. You don't want to be like a one-man band trying to renovate a house in 6 weeks, because you'll never get it done. If you've ever seen people trying to renovate a house by themselves, it normally takes them like a year. So you don't want to do that. You want to be in and out 6 weeks, and you want to get all your scope lined up. So all the scope items, and then your tradesmen, get them in early to price, and then have them all lined up on certain days. And if you aren't in the building industry and you don't know when to bring the trades in, well, all you need to do is just ask them, say for example, you're talking to the electrician or the plumber, just say, hey, when do you need to come in? Or you just get them all to meet and they just talk to each other. And they'll say, hey, I'll come in on this day. Why don't you come in after I finish this? So just think about how you can better coordinate people together. And you don't have to be the expert. The tradesmen are the expert. Like I was literally doing renovations when I was 23. I think I'd never done a renovation. Oh, no, I was 22. I was still 22 when I was doing the renovations. I'd never done a renovation before. Literally, it was the first property I bought, and they were structural renovations. I had no idea other than I did a renovation course and they sort of taught me how to do renovations. So I was like, all right, cool. I have to work this thing out. So I just literally got everyone talking to each other and I found out all the info and I learned who comes in here, who comes in there. But anyway, back to your question, where do you look for renovation uplifts? Where there's a big pricing disparity, where you can buy something unrenovated for 250 grand and you can sell it into the market for 450, like an example I just mentioned before. And if you want to know where that is, that property was actually in Rockhampton, of all places. So it was a property in Rockhampton. They bought it less than 12 months ago for 250. They did a reno on it, probably spent 70, 80 grand, and they sold it for 450. Now that is a market that has boomed over that period as well. And it's probably got a little bit left to run in that market. But you just got to be careful. Regional markets, they can really crash on you hard, really fast. So that's what you look for with renos and cosmetic renos. So you're not spending a whole lot of time and money doing the renovation. Oh, just one other key with renovations is I did renovations with cash. So all of the costs with the renovation, I never borrowed it from the bank. I went and got a bank loan for the main purchase. And that was just a residential loan. And then all of the renovation costs themselves, I paid for with cash. The reason I did that is because it's too hard to get the bank to try and loan you money unless you've got an overdraft facility and they don't ask questions. If you go to the bank and say, hey, I want to renovate this property, they're going to go, okay, get me 3 builder's quotes, get me this, get me that. What's the builder's insurance? What's this? What's that? And then by the time you do all of that, you've just wasted 3 months. Then they've got to approve the loan. So you got cash in the bank, you settle the property, you start works the next day and you can start paying people. Get it done. If you want to hold the property, you refinance it thereafter. You get a new valuation, tell them you've done a renovation on the property, and then you redraw the cash if you want to hold the property, or you then go on sell it. But I think if you're in a growth area, and this is why it pays to know what market cycle you're in for your suburb. If you're in a growth area and you've just added 50 or 100 grand in value to your renovation and you can rent that property out and then it gives you extra cash in the bank. If you can hold it long term, the biggest cash or the biggest equity gain that you'll get isn't from the renovation. It's actually from the buy and hold. So you'll make more money from buy and hold than what you will from doing a renovation and what you will from doing any development. In my experience, it's just that buy and hold, it takes longer, but you're not having to work it. You're not having to be on site telling tradesmen what to do, or development. You're not having to get the approval, do the building. You literally do nothing and you get ultimately passive uplift. And then at some point in the future, you may choose to sell that home. You may refinance it, but it's money while you sleep. Whereas renovation, development, it's active. You need to actually work it to manufacture the equity or manufacture the profit. All right. Renovation for uplift, red flags for builders. Not sure what you mean by that. Let me know in a bit more detail, as in what red flags I look for. One lender said something about lending based on end value. What does that mean? So with development and potentially renovations, if you're doing a bigger one, some lenders will lend on end value. So what they believe the value or the property is worth at the end. So typical with a house build, for example. So you buy a block of land, you build a house on it, the bank's going to lend you on the end value of the completed product. So renovations can be the same. Now, I personally haven't financed a renovation. I've always paid cash for renovations because it's a painful process. But the bank generally, they'll value the property as if the renovation's complete, assuming you've got plans and everything to show the value. But if you don't have plans, if you're just doing a cosmetic reno, they're not going to really value it because they don't know what you're going to do to the property. And that's why it's a pain to try and borrow renovation money from a bank. So for those people that have joined, we're talking about renovations. And this was, I'm just going to go back to the original slide. This was a property I renovated, which was the Ugly Duckling, where I made $53,000 in my lunchtime. This was 10 years ago, this property. I did this. All right, last few questions, and then we'll wrap it up. All right. Do I have any thoughts on modular? Modular is when you join multiple buildings together and you put them on stumps. You've just got to check the financing. A lot of financiers won't finance a modular, or if they do, they might be more constructive, or you might have to go with the second or third tier. And you've also got to check the resale values with modular as well. So a lot of people will discount modular unless you dress it up and make it non-modular. But I feel like modular has like a caravan park kind of feel. So if you're in like a caravan park and that's what you're going for, then I think modular is great. But honestly, by the time you muck around with modular, and people have tried it, and I've seen people do it, and it ends up costing them just the same as if they had it built on the property. So I'm not a huge fan of modular, but I think if you can make it work, or if you're somewhere remote, maybe it could work, but just make sure that you don't overcapitalize or you get your end values right. That's my biggest concern with modular. Maximum LVR for commercial finance, normally 70%. Does the conveyancer draft up the JV contract, or is it legal? Does the conveyancer draft up the JV contract? Oh, no. So conveyancers just do the conveyancing. So conveyancing is the act of buying and selling property, or the process of buying and selling property. You need a lawyer to draft a JV contract. There is no set standard. In my development course, I do have an extensive checklist when you do a JV contract. But if you don't want to do that course and you want to ask your lawyer, what should I include in my JV contract? You can do that. But generally with the JV contract, you have two or more parties, but you just have different roles that each party performs. And then you have like some default provisions if there's an argument and people can't agree and all that stuff. So the JV, for those people that have jumped in, the JV I did on this property was one party was the money partner, and I was the other party that got the bank loan, and I also did all the work. And this one was I think it was a 50-50 off memory. It was 10 years ago, but the JV was one party, my other party was the money partner, and I provided the bank finance and the work. So I didn't have to put in any money. How much to join your course, and we'll be able to interpret the data you use. So there's 3 levels of my courses. The cheapest one is $400. It is a crash course into what's called the SR method. If you want to look that up, go to libertyblue.com.au. So I've got a $400 course, and then the upgrade from there is $6,000 for the accumulator. And then the development course is $7,000, and then there's mentoring, which is a package of $12,000. But if you buy multiple courses, so if you buy the SR method and want to upgrade, we credit you back on the next course. And then if you buy multiple courses, I do a massive discount on the whole lot. But the amount of content in my courses, just to give you an idea, the accumulator has about 40 hours of video content, and it's got a whole lot of resources. It's probably got 30 different resources, and then the upgrade. From there, the development course has 130 resources and about 45, 50 hours of content. So if you are going to jump in and do a course with me, I don't have any BS upsell courses. The course you buy is it, and I'm always adding to it and refining it. So you do get lifetime access to it. There is a lot of content in the courses that I do. I'm personally, out of the dozen odd courses that I've spent hundreds of thousands of dollars on, I've personally not had any course have the amount of content that mine has in it, and the number of resources. Because if you are doing a project and you want to do it properly, I'd rather give you everything and you not be left in the lurch about something. So I've had people do my development course and decide not to do development, to actually decide to do buy and hold or do a renovation. And I think that's fantastic, and then upgrade thereafter, because they've seen what's involved and it's something that they want to do later on in the future, or they've decided not to do it at all. But the skill set in learning about development is transferable to other buy and hold passive properties. I was talking about units earlier. If you know the development cost of a unit for example, and you're buying under market value and you know that a developer can't replace that unit for the same price, like that skill set in itself is invaluable. So if you know what the costs of a development is, you don't have to be a developer to make money from development. You can be a buy and hold passive investor. If you're buying below replacement cost, if there's an undersupply, which is happening now in the market. So if you're buying a unit and you're buying it for 500,000, just for argument's sake, and you know the replacement value of that unit is 700,000 and there's an undersupply, what's going to happen when a developer like me moves in and builds units? We're going to price them. If the replacement value is 700,000, we need to make a margin on that. So our new units might be at 900,000. And that's what's happened in the market over the last couple of years with building prices increasing. So if you can understand the costs of a development, you can understand where there's true value in certain products, not just units. They can also be, single house and land packages. For example, it can be in the land lot. I see a lot of land properties sell pretty much below replacement value, below what I could build it for as a developer. Obviously, I would never develop that because I'd be losing money. But for somebody buying into that estate, you're buying it basically at cost or below cost. So if you know that information, you can be a lot more powerful and buy things in the market better than everyone else. So anyway, to answer that question, there's 3 levels of courses. There's a base model course for 400, which is the SR method. There's the accumulator for 6,000, which is about accumulating multiple properties. And then the upgrade is the development course for 7,000. And that was a long-winded way of telling you about the courses. Just jump on libertyblue.com. They've all got free training. If you want to start at the SR course, start at that, and then you can always upgrade from there. All right. How long have I been teaching for? A little while, 3 years, maybe 2.5 years. I have 0 houses. I know how to read the data to identify boom locations. Do you recommend just going with the developer course? It depends on your strategy. If your strategy, and with the developer course, I explained about how many resources it got. It has development is a lot more involved than just buying a passive investment. So if you want to go hard and you want to build in or manufacture equity and you want to go down that development path, I truly think development is the fastest way to get there, but it's not for everyone. I still think you can make a whole lot of money being a passive investor and buying properties, identifying them in boom locations, buying under market value, and just sitting and waiting. So yeah, it depends on what your end goal is and also what time commitment you want to put in as well. So if you watch the free training, it'll give you an idea. The free training that I provide, it does go for an hour. So it gives you a bit of an in-depth into what is involved in the program. And then I do a walkthrough on what the modules are. So hopefully we'll give you enough information to make an informed decision, which path you want to go down. But look, not everyone is the same. I've got people in my development course doing $500,000 to $1 million per year. There's people in the accumulator course that are buying multiple properties. Maybe they're not making $500,000 to $1 million cash, but over time, that accumulation of properties will far surpass the $500,000 or $1 million a year. And it'll be done with a whole lot less work. So it's really time commitment and also what you want to get into. But I think development, even if you know about how development works, it's going to help you in all aspects of property, even if you decide not to be a developer. All right, is there a way to find a development site and sell to a developer without developing it? So yes. So you can become basically like a buyer's agent for development sites. There are other ways where you can get into development with no money. You don't actually have to develop the property. You can flick it on, or you can put your foot on it, control it under a contract, and then pass it on to a developer. So yes, there are different ways to be creative, knowing what a developer knows, but being able to flick it on to the ultimate buyer, the ultimate developer. That happens all the time in development. And obviously the other part of development as well, developers generally have a lot more money, so they pay a lot higher prices. So if you're the middleman with development sites, you can pick up 50 grand, 100 grand by flicking on a development. If you put it under option, especially for bigger sites, you can make several hundreds of thousands of dollars, but don't expect to do that if you're just fresh off the boat and you've never done development. Don't expect to pass on a deal for $500,000 after 3 months or 6 months. The guy's doing, and I'll tell you about one particular person that's doing my course. It's probably on track to make $500,000 to $1 million. They had other investment properties. They decided to sell all of their investment properties and go into development, like head first. And they quit their job to do it basically full time. So they were all in. And I think if you're going to do something and do it properly, just from my own experience, I went hard at development and I made it work. So if you go all in, and you don't have to sell all your investment properties to go all in, but if you go all in terms of you learn the material and you action it, it works. It does work. But if you don't put the time in and the effort in, then it's not going to work. That's ultimately the outcome. If you want the results, you need to put the work in. If you go to the gym, for example, and you cheat on the gym and you don't go some days, well, then you're not going to get the outcome that you desire. It's no different. You just got to put the time in. So the time I recommend is 3 to 5 hours per week minimum, but it's got to be consistent. You can't be missing weeks. A bit like the gym. If you miss a week, you don't just miss a week, you actually go back. So I'll answer the last one, and then that will be it. What do I think about options flipping? Does any of your courses cover that? Yes. There's no point in doing an options course, in my opinion, if you don't understand the full cycle, because anyone can option up a property, but you need to option it up for the right price, and not waste your time on certain properties. So if you understand the full development cycle, you are going to option up the right properties. So many people I see option up bad properties, or they waste all this time on a property, they negotiate it, and then they work out that you don't make money on it. So my strategy, my development strategy, and what I implement in my own investments and developments is I do a top-down approach. So I actually develop the financial model first, and the financial model is basically copy somebody else. So don't reinvent the wheel, copy what other people are doing. So develop the financial model, reverse engineer somebody else's model. And that is the same with renovations as well. That renovation I mentioned before, I saw a property somebody bought for $250, they sold it for $450. You just copy paste what somebody else did. So there's your financial model. And all you do is just find every other property that you can buy for $250,000, and you just do the same thing. So same thing, or exactly the same theory, principles behind development. Find a model that works that you can make money on. Then if you want to option it, then you can option and flick it on and then you'll know what your margin is. So you're not spending all that time optioning up the wrong property. All right, I've answered everyone's questions. Thanks so much for watching, everyone. If you've enjoyed the live session, I may do one in another few months. I will make the whole session available when it becomes available through the YouTube channel. I'll send everyone a link. So thanks for jumping on. And if you've got any further questions, just let us know. And if you want to watch the session later on, you may do that. See you all later, and I'll see you on the next one. Now I just got to work out how to